Both Democrat and Republican lawmakers say it's time to get tough with OPEC after they announced major cuts to their oil production, a move likely to spike gas prices.
We call it NOPEC.
So, by the way, the No Oil Production and Exporting Cartels Act, known as NOPEC, working its way through Congress, which would effectively permit the United States to sue a group or a nation that is involved in an OPEC.
In our previous series, we discussed how OPEC and OPEC Plus control oil prices and their impact on the world economy. If you haven't seen our first episode of OPEC series, we highly recommend that you can check it out from the suggestion link above. So in this episode, we'll be taking a closer look at the NOPEC bill introduced by the US and its potential impact on the OPEC's ability to control oil prices. Not taking much time, let's get into the video. In the past, OPEC relied heavily on production cuts to control oil prices and maintain their market share. However, with the growth of US shale production in recent years, OPEC's market dominance has been challenged. As US shale oil production increased, OPEC faced increased competition, which led to a change in strategy. In 2014, OPEC decided to abandon its policy of production cuts and instead chose to maintain production levels, which ultimately led to a drop in oil prices. The goal was to put US shale oil producers out of business by driving down prices and making it unprofitable for them to continue production. However, the strategy was not entirely successful. While some US shale oil producers went bankrupt, many survived and adapted to new market conditions. As a result, OPEC was forced to revert to production cut in 2016 in an effort to raise prices and regain market share. In recent years, OPEC has also shifted its focus to collaborating with non-OPEC oil producers, such as Russia, in an effort to control oil prices and maintain market stability. This collaboration has been successful in stabilizing prices to some extent, but it remains to be seen how effective this strategy will be in long term. And there comes our video's most important part, the NOPEC Act, or the No Oil Producing and Exporting Cartels Act. It is a proposed law in the United States that seeks to maintain oil producing and exporting cartels such as OPEC illegal under US antitrust laws. The act would allow the US government to file antitrust lawsuits against this cartel for artificially inflating oil prices and manipulating the global oil market. The bill has been introduced multiple times in the US Congress but has not been enacted into law. But in March 8, 2023, US senators have reintroduced the NOPEC bill. If it gets passed, the act would allow the US Department of Justice to sue OPEC and other oil-producing countries for price fixing and collusion. It also seeks to remove sovereign immunity protection that currently shield these nations from lawsuits in the US. The act aims to increase competition in the global oil market and prevent artificial price manipulation by oil-producing nations. However, the NOPEC Act could lead to increased litigation and trade tensions between the US and OPEC member countries. This would have a ripple effect on the global economy, as higher oil prices would translate into higher fuel prices for consumers, which could lead to inflation. Businesses that rely on oil and gas, such as airlines, transportation, and manufacturing, would also be affected as they would face higher operating costs. Moreover, the NOPEC Act could also impact the US economy and investments. If OPEC countries reduce their oil production, this could harm US oil companies, particularly the shale producers who have gained the market share in recent years. It also leads to a decrease in US oil imports, which would have a negative impact on the US economy. And also, investors in the oil and gas sector would also be affected by the NOPEC Act. The uncertainty caused by the proposed law could lead to increased volatility in the energy market. Additionally, the potential for trade tension between US and OPEC countries could lead to a decrease in foreign investment in the US. In conclusion, the global economy is heavily dependent on oil, and fair competition in the oil market is crucial for its stability. The monopolistic practices of the oil-producing nations have resulted in higher fuel prices and inflation, affecting consumers and the economy at a large rate. The introduction of NOPEC by the US could be a significant step towards breaking the oil market monopoly, but it could also have unintended consequences on the global economy and investments. It is imperative to strike a balance between fair competition and stability in the oil market, and the policymakers must consider all possible consequences of their actions. As the viewers, I encourage you to share your thoughts and opinions on this topic in the comment section below. Thank you for watching, and please consider subscribing to our channel for more contents on current event and global issues.